In this video, we will try to learn more about the mean reversion factor. You may have wondered what happens when we set the constant g, that determines the level of autocorrelation, to negative values. Before you do it, think about what might happen to your backtest results, and then confirm whether it did what you expected. Running with negative g, we can clearly see the negative correlation now. So does this mean we have negative trending behavior now? No, not at all. More often than not, the price chart will look like this. With negative autocorrelation, we end up getting mean reverting properties in our time series. In other words, when the series has a positive return, it has a tendency to produce a negative return next. As always, in the real world things are not quite so obvious. Let's examine the SPY ETF for the S&P 500 index. We use the df.shift-1 to shift the data frame to the left, and when we plot the returns against each other, we find small but clear negative autocorrelation. This leads us to the conclusion that on this time frame the SPY returns must be mean reverting. When we consider a trading strategy in this time resolution, we need to take this into account. Now let's resample the date to a 3-month resolution, and repeat the process. You may wonder, why is the SPY mean reverting in the short term, and trending in the long run? Is that even possible? In short, it sure is. Think of a sine wave which slowly rises over many periods. Looking closely, all we see is a sine wave, but from further away we see a rising line. It is all a matter of perspective. Let's now run a backtest with the 3 months resampling. Remember when we talked about alpha, and the skill of a money manager, to produce returns independent of the market? Let's use this as an example. Plotting the strategy returns against the market returns, we find two things. First, our regression slope is 0.01, which means that the correlation of our strategy with the market is effectively 0. Second, alpha 0.01. This means that it produces an average 1% return on a 3-month basis, or 4% annually. We call this the annualized alpha. This does not look amazingly impressive at first, but you will soon notice something interesting. What if we combined a buy and hold of the SPY with a 3-month momentum strategy? Here we put half of our resources in each part of the strategy. We can see that it underperforms our benchmark somewhat, but at the amazing benefit of much smaller drawdowns. Judging a strategy purely by its returns is a very bad idea. A better metric that is used often is the annualized risk-adjusted return. Here we divide the mean of the returns by the standard deviation of the returns, and multiply it with the square root of the periods we see in 1 year. In our case we have 4 quarters, and the square root is obviously 2, hence the factor 2 in the calculation. It may be possible that the risk-adjusted return of our strategy is significantly higher than the buy and hold benchmark. For many investors there is a clear advantage in that, over making some extra profits. Now, while this is not a phenomenal result, it demonstrates the workflow of finding micro-alphas, in its most basic form. This is just the most basic workflow, and as we go along in the course we will gradually add complexity. Also note that a 3-month holding period is not generally considered a micro-alpha, but again, it serves us really well for this demonstration. That was all for this video.